All right, Frank, good to have you back on the podcast. Looking forward to our subject today.
Thank you.
I think we've got a good one for our audience here, and it's something that is very common amongst investors, pretty much universally. And what we're talking about today is separating that emotional instinct from the fundamentals and logic of investing. Because as one accumulates finances, puts those to work in the market, of course, as much as we would like, the market does not go up every single day. And it can get emotional sometimes when there's volatility in the market, when there's swings, and working with someone and then understanding the reasons why we're going to separate our emotions and even what can be a very emotional stock market itself from the fundamentals, from the logic that actually drives the long-term price action is extremely important.
Well, certainly, and it's easy to understand why emotion could come into the picture because you're dealing with money that you worked hard for. Sometimes later in life, it's money that you worked hard for your entire life. You've accumulated it and you're expecting to enjoy a nice retirement from it. Emotion is something that we see regularly. And I think that's one of the things that I'd say that, having an advisor actually really helps because it helps put a buffer between emotion and illogical action.
Exactly. Yeah, I think that's one of the biggest things that our clients are getting value out of whenever they, use us or use somebody else as an advisor is to bounce off those ideas, to understand the difference between something that is an emotional reaction versus something that's rooted in reality or in logic or fundamentals when it comes to the stock market or even individual companies. And so I think that's what we should really talk about today throughout the conversation, talking about, the importance of that advisor aspect. But, first kind of want to talk about why do we get emotional in the first place? And then I think something else that's really important is there's so many things, especially today in this immediate news cycle, that really drive those emotions up. I mean, we've got an election pending here, which just seems to ramp up the emotional aspect of things. And so I think you've got all these individual factors that are really contributing to it, especially right now.
Yeah, that's a good point. And the fact that most people, or very many people, well, let me back up. I'll say that one other thing that I think that, I'm going to toot our own horn for a second, but I think the fact that we have individual companies that we're investing in instead of mutual funds, ETFs, indexes, that really helps someone stay rational during volatile times or during times that they perceive that there's extra danger in the market because they look at an election and they think, oh, if my guy doesn't win, then what's going to happen to the economy? And maybe I need to sell out. Well, it's easy to sell out when you're talking about an index because how can you have conviction in anything that's just a number? The number goes down and you're hearing bad news and there's people out there advertising bad news and advertising you better watch out because I hope no one sells out of their stock positions to buy an annuity. But that's the kind of thing. And it feeds on the emotion because you're hearing it everywhere. You're seeing it when you search for something. You're seeing those are basically ads. They're clickbait. They can't sell you something if they don't get you to sell the assets you already have. And by investing in individual companies, it's a lot easier during times like that because you say, okay, I own Walmart, for instance. Well, is Walmart going to change? Is it going to do a whole lot better under one president versus the other president? I think Walmart's probably just going to keep on doing Walmart. Good company, it's solid. We know what it does. Easy thing to have conviction in. Other things, Microsoft, I can name a lot of companies that you know what they do. They're easy to have conviction in bad times. So it doesn't get you to sell everything. Whereas an index, it's real easy, especially if you're just in a few indexes or in a few ETFs and mutual funds. It's real easy to sell out of the market. Now, the downside is that now you're out, and when do you ever get back in? It's really hard to pull that trigger to get back in because you might watch and you say, oh, I'm glad I got out. Things are still going down, but then all of a sudden they level out. Maybe they spike back up because of different news and news that's counter to the news that you were hearing before. and you start thinking, well, I'll get back in, but now the prices are higher than where you sold out. And the other thing that you get to look forward to come January, you get to look forward to a big tax bill because you sold out. So now you owe taxes on all the gains that you had that you sold.
Yeah, and I mean, just going off of that, comparing the stock market as this whole kind of obscure entity to individual companies, I always like to look at this whenever individuals ask me, of course, as a financial professional, they're always asking me, hey, what do you think the stock market's going to do over the next year, over the next 6 months, or into year end through the election? Well, I really like to look at it rather than a stock market as a market of stocks, because you and I are investing in individual securities. And to your point, if you have conviction in the underlying companies that you are buying and owning, and you feel that even though the broader market may be swaying every which way, if you have confidence in the fundamentals and the reality of those companies, then you're much more likely to stay along for the ride as an investor than you are if you're just looking at number on the screen, S&P 500 or NASDAQ or Dow, because you're just focused on that number bouncing up and down. You're not thinking about the underlying companies. Whenever you're seeing on your portfolio, those individual companies maybe moving up or down. Well, if you look at it from a long-term perspective, which we always should be as investors rather than traders, it's important to realize the fundamentals of those companies. And maybe a one-day swing in a company of 5% or a short-term pullback in the broader market of 10% doesn't mean that the outlook or the fundamentals for those individual companies that you own is actually any different than when you had bought into them or owned them a week before when they were 10% higher.
Yeah, surely. And what we talk about a lot in the office is anything in our 30,000-foot view of the world changing? Now, granted, there's elections, and some sectors of the economy might do a little better under one president than the other, and other sectors of the economy do better under the other person. So you might look at it and say, well, the 30,000-foot view has changed a little bit, but then you can migrate your portfolio a little bit. It doesn't mean that it's a wholesale out and a wholesale in, because I mentioned Walmart and Microsoft earlier. I don't really see that either one of them is going to do inherently a lot better or a lot worse under either presidential outcome. There's a lot of companies that you can hold that will do just the same under either scenario. Now, there's some sectors that will do a little better under one and the other, but money always moves to wherever it's treated best. So you have an election outcome. Why not spend your time, instead of fretting, spend your time figuring out what is likely, what companies should I be looking at? What is likely sectors of the economy that might benefit under a Harris presidency or might benefit under a Trump presidency? And also which ones might get hurt? Which ones do I might want to lighten up on when I see the result, and use that money to go into a little heavier into the areas that will benefit? That makes sense, and it doesn't result in being out of the market, because money's going to be flowing somewhere. It doesn't just disappear.
Right. I think there's always an area of the global marketplace to be in, whether it's a different economy, say outside the United States, or it's a different asset class. Maybe it's, bonds or alternatives instead of equities, or vice versa. I think there's always an area where you can benefit from what's going on fundamentally. And I think the interesting point, and something that we kind of talked about, before this episode, was that if you're a long-term investor, you should focus on exactly that, the long term. Because if you're setting up a financial plan for yourself, you're going into retirement, you're looking for a long-term solution. And the market is not always going to price in fundamentals in the short term. But if anybody's getting emotional about what's happening right now, this week, this month, or even the next 6 months, well, I'd say if your investment horizon is less than a year, I mean, what's the point of being invested in the first place? You're growing this for the rest of your life or for posterity. You're looking to accumulate wealth, help your dollars build on themselves. And so don't get too myopically focused on what's going on in the here and now, because the market on a short-term perspective can be extremely emotional because at the end of the day, it's driven by individuals. And I think something that we've been talking about too is that with the proliferation of computer-based trading with algorithms, at the end of the day, those aren't thinking for themselves. They're coded by an emotional human. And whenever you get that first emotional reaction to a lot of these data points, or even a headline that may not actually have much important implication for the broader market, you can have huge swings that get built upon because of this computer trading that, maybe historically it wouldn't have happened that way. But that also lends itself to our job where we can kind of take advantage of some of that.
Certainly. And the computers get going because they are programmed in advance. Keep in mind that this is not a dynamic program going on, it's static. It was programmed a month ago or 6 months ago or whenever the last time they changed the program. So they had to decide on these words are sell, these words might be buy, but sometimes those words don't aren't interpreted exactly the same way, and you get a little misinterpretation by the algorithms, and pretty soon you have this bombardment of trades that are going one direction, maybe in the selling direction. Now you add on that people start seeing this, people emotional, and some of these emotional people are actually in the business. So there's a lot of money that can be pushed. It might last a day, and sometimes it lasts 5 minutes, but sometimes it lasts a day, a couple of days. But usually this is days or at the most weeks. This isn't months. This isn't years. This is just a dislocation. And what it really is we find very often it's an opportunity. So the best thing to do at that point is not start thinking about I need to sell out of the market. The thing you need to do at that point is look, and especially if you have individual positions, then it's a lot easier. You say, well, has anything fundamentally changed? Has really my 30,000-foot view of the world changed with this information? And sometimes you look at the information and just say, I really don't think that it was interpreted correctly. I think that this is a buying opportunity. Sometimes you say, hey, this is not a buying opportunity. And sometimes you look at it and you go, wow, the market just gave me a great opportunity to pick up a great company at a bargain price.
Right. Exactly. And I think a great example of that was we saw very end of July, beginning of August. We had 1 week of jobs numbers that didn't look great. And all of a sudden, the whole market's stressing out about economic growth, about are we going to be okay as an economy? The Fed hasn't started cutting yet. So are we going to be in a place where we can achieve this soft landing scenario? And the market pulled back in just, under 2 weeks, almost 10%. Well, we were looking at this and saying, hey, I mean, yeah, we got a couple of data points here, but if you want to build something based off of fundamentals, you really need to see more than just a couple of sources that are showing this kind of information. Because we're looking at the broader market, looking especially going back to the individual companies that we own and saying, hey, this isn't really impacting the companies in our portfolio, but it's not even really impacting the broader economy. So what are we going to do in this kind of situation? We're not going to freak out along with the rest of the market. We're going to take advantage of some of this. And so that meant, putting some money to work in that scenario. We saw that almost 10% pullback. And then we saw over the following 2 weeks about a snapback right back close to where we're at now at almost all-time highs. And so
Certainly, we ended up the month as slightly positive. And that was after right in the middle of the month, there was so much doom and gloom out there. I don't care if you turned on the TV or if you pulled up Yahoo Finance or something. It was doom and gloom all over the place because that's what people write about when there's doom and gloom, because they can get you to click on their article or click on their product, whatever.
And I think that's exactly right. Going back to what we were talking about, computer-based trading and the interaction with the market, it's interesting how you can get so focused on these short-term events. I mean, look at even the Fed meetings, for example. You've got Jerome Powell comes out, gives this press conference, and if he starts the meeting on a hawkish note, meaning tighter monetary policy, bad news for broader stocks in general, a lot of times that can get compounded. And even if he finishes the end of the meeting on a high note, saying, "Hey, things are looking good. We're in a good spot to cut. Economy's fine." The market may have already gotten carried away with what they started with. And so I think the whole point of this conversation being it's our job to put that emotion aside and really focus on those long-term fundamentals as far as how we're investing for our clients, because that's just going back to the whole investment plan, investment strategy in general, and working towards the long term.
Certainly. I think that you made a point earlier and about a data point. It might be a jobs report. It could be the inflation, one of the inflation numbers comes out or something. One other thing that people need to focus on instead of reacting to one data point is that, look, we're getting these either weekly or we're getting them the same one every month. And almost invariably, last month's is revised. They say, oh, well, we missed the real number last month and then we're going to revise it to the correct number. And so they're being revised. And if you just look at a moving average, you can get a better, it's kind of like stepping back, and instead of focusing on one tree, you can kind of look back and you can see the forest and you can see what it really looks like. So you don't get caught up in that quick emotional reaction.
Right. And I think this extends to individual securities as well. I mean, we've been talking about the emotions of the broader market, but a lot of times we'll see maybe an earnings print or some headline kind of news that comes out about a company, and initial market reaction is, oh no, this is bad. But then once you start reading through the information, the data, it may not actually apply. And then all of a sudden you get a great buying opportunity on a company that you like, or the converse can happen as well. Say investors all of a sudden get super bullish on a stock or maybe the broader economy, but it leads things to get over their skis a little bit. It gives you an opportunity to trim as well. So I think the whole point about tactically trading around these things is first and foremost, most importantly, deciding, hey, is there something fundamentally that has changed with either the broader market or with this company? And so is there a macroeconomic event that is going to change how we view investments? Or is there something company specific that changes the way that we view that company? Now, if there's not either of those two, but there's a big swing in prices, that means there's probably some opportunity there.
Yeah, certainly. And with that, if you have a company that goes up 100% year to date, well, perhaps you do want to, if your plan really, your portfolio was constructed so that that company would be, say, 2% of your portfolio. Well, if it's growing that fast, now maybe it's 2.5, maybe it's 3% of your portfolio. Well, then maybe it makes sense to go ahead and trim it back closer to that 2% that you had initially decided it would be. And that way, if something comes out in an earnings report, whether it's real or just misinterpreted, and the that company stock starts to drop a little bit, a lot of time the emotional people, they'll go in there and they'll make that thing drop much further than it should. Well, if you've already have trimmed and kept your position about where it ought to be, well, the drop in that could give you an opportunity if the company and you are looking at the data and you say, okay, a lot of these people, they just took that little bit of information and now they've also made 100% year to date, and they're starting to pocket some of their gains. It doesn't mean that they're selling out of the position. It doesn't mean it's a bad company all of a sudden. It's just going through a little bit of consolidation. And maybe now that thing if it drops significantly, maybe it's only 1.5% of your portfolio and you want to add some back at a cheap price.
Right. And I think that's exactly right on, because once you decide if something fundamental is really going on, and if it's not, and you want to make an action on a company or the broader market, the next step is your position sizing. And so whenever we talk about these tactical trades in within a long-term investment perspective. We're not talking about betting the whole ship on an individual company if it has a pullback, or, selling everything out if a stock gets extended. We're talking about right sizing these things so that you are, chipping in or cutting back to some extent. We're not moving in and out of the market because, to your point from earlier, the tax perspective is something that we really have to pay attention to whenever managing these trades. And so making sure that, like you said, in January, you don't have some huge tax bill because you decided to get all out of the market and throw it back in and take it out, is really important for our clients as well.
That's another benefit to owning individual securities, because sometimes an individual security may be a great company, but something happens, and it may be short term. It's something that's not going to affect that company and its profitability 6 months from now or a year from now. It's just affecting it right now, and maybe it sells off hard, and perhaps you were unlucky and just added it to your portfolio recently. Well, sometimes it makes sense that, yes, I can capture that tax loss, let the IRS pay whatever your tax bracket is, 30, 40% of the loss. All you have to do is stay out of that particular stock for 30 days. And 31st day, you can buy back in. You get to maintain the tax loss. It's not a wash sale that way. And then you're right back in your position. But to prevent, now I would do that not on something that I thought that was just a very short-term misinterpretation, but something that might actually affect the company for the next, month or a couple of months. And very often, if you want to, here's a good use of the ETF or of another similar company. If it's say it's a copper company like Freeport McMoran, and you're in that, and something takes place, whether it's short term about copper or short term about Freeport, what have you, you can take that tax loss, and then you can go in and take that same money, same investment, buy Southern Copper. So, and maybe you're getting it at a big, maybe the whole copper index was hurt by this short-term news. So you're selling one, taking a tax loss on it, and you're buying into another one. So if it comes back sooner than the 30 days, you're still participating in the gain. And if not, well, you bought in at the bottom, or what you think might be the bottom, or you bought in at a good price.
Yeah, that's exactly right. And I think kind of the last thing that I want to talk about, as far as what I want our listeners to get from this, or clients that are listening, is that, once you've established an investment strategy, once you're on board with either your advisor or maybe it's your own kind of investment strategy, you don't need to be looking at these things every single day. I mean, that's our job, is to make sure that we're following the markets, seeing if anything changes. But it is long-term investment for a reason. There's a reason why we call it investing. I always like to reiterate that, is it's investing, not trading, is because we are looking for growth in these companies in the long term. Because, like we always say, I mean, you own a piece of this company. It's not just a number on a screen. This is a real percentage ownership that you have in these individual equities when you're talking about stock ownership. And so maintaining that long-term perspective is always important, because our news cycle these days is so fast, with social media, with all the news outlets, with the algorithmic trading and computer-based trading we're talking about. Everything reacts on such a short term as far as information goes. But whenever you're focused on having the right fundamental approach, investing in the right companies for the right reasons, it's much easier to just focus on the long term, because I'll have much more confidence in telling you what a company's stock price is going to look like a year from now than what it's going to be at in 3 weeks.
Certainly, yeah. 3 weeks is something. Short term is something that you can step into the market or step into a position with a company in pieces to mitigate short term volatility, or just plain old being unlucky. Uh, because if you buy the full position, or you go from not invested to fully invested in a day, well, tomorrow may be that bad, unlucky day, and all of a sudden you're starting 10%, in a hole. So it makes sense you can step into positions. You can actually trim positions instead of selling out. There's a lot of things. But the other thing, I like the point you made about don't look at this every day. I mean, you can pay attention to what's going on in the world. If something significant happens, well, think about it. Doesn't mean that you have to look at your portfolio and say, I got to sell out of the market. What it really should mean to you is that if you see something like that, yes, do the analysis, but stay away from looking at everything on a daily basis. Go enjoy. If you're retiring, first of all, I'd suggest you get someone to do it for you. That's kind of plugging ourselves, but because I think what it costs you as far as fee is more than compensated by extra return and someone who has a lifetime of doing it versus you've been doing a good job at something, you're a smart person, and now you're going to retire from that and start a whole new career, and it's going to be investing your life savings.
Yeah, I mean, I think peace of mind and lack of stress are worth a whole heck of.
And being able to go play golf or go to the lake or take a walk or something and enjoy the retirement instead of coming up with a new career.
Right. Exactly. Well, I think we did a great job covering covering the emotional aspect of investing, talking about, hey, focusing on fundamentals, long-term perspective. These are what our clients and listeners should really be focusing on. And Frank, thanks for joining me on this podcast. I enjoyed it.
Thank you much.